For generations, this was the bedrock of investing. The simple, elegant 60-40 portfolio. That's 60% in stocks, 40% in bonds. It was a strategy so trusted, it pretty much became the default for millions of people. But then, 2022 happened.
And just like that, one brutal year of performance sparked this massive debate all across the financial world. Was the 60-40 model, the one we all counted on, officially dead? Okay, let's dive right into this.
Because this is the number that caused all the panic. In 2022, the 60-40 portfolio saw a peak decline of 17.5%. For a strategy that is literally designed for stability, this felt like a catastrophic failure. So that catastrophic failure, that's our starting point. To figure out what the future holds for this strategy, we first have to go back and really understand what on earth went so wrong during that historic crisis of 2022.
The whole idea was beautifully simple. I want you to think of it like a two-legged stool. You had stocks, which were your engine for long-term growth, and then you had bonds, that steady leg, providing stability. The idea was when stocks zigged, bonds were supposed to zag. But 2022 was just different. As this quote lays out, it was a complete anomaly. For the first time in modern history, the core principle just failed. Both stocks and bonds fell hard, and they did it at the same time. The diversification that was supposed to protect everyone, it just vanished.
So what was the villain in this story? What caused both pillars of the portfolio to just crack at the very same time? Well, the answer can be summed up in one single word: inflation.
Now, to really get this, we need to understand a key concept called stock-bond correlation. It sounds fancy, but it's just a way of asking, do stocks and bonds move together, or do they move in opposite directions? For the 60-40 to work its magic, you really want that correlation to be negative.
And this slide illustrates the problem perfectly. In a low-inflation world, everything's great. The correlation is negative. Bonds act as a ballast, so when stocks fall, bonds rise, and they cushion the blow. But in a high-inflation world, that relationship completely flips on its head. The correlation turns positive, and when stocks fall, bonds fall right along with them. They sink together.
So what's really wild about this is the specific tipping point. Historical data shows that once inflation crosses a threshold of just 2.4%, that stock-bond correlation tends to flip positive. And when that happens, the risk in a 60-40 portfolio jumps by a staggering 35%.
And that's exactly what happened. The inflation spike of 2022 just blew right past that 2.4% threshold. It flipped the correlation positive, and it shattered the entire foundation of the 60-40. Both legs of that stool gave out at the exact same time.
But just as everyone was writing its obituary, something pretty remarkable happened. The 60-40 didn't just stabilize, it came roaring back.
As it turns out, any reports of its death were greatly exaggerated. The whole narrative of a broken strategy pretty quickly started to unravel. And the data here shows just a stunning V-shaped recovery. I mean, after that brutal 16% loss in 2022, the strategy posted double-digit returns for 3 consecutive years. It was an absolutely incredible turnaround. So the crucial point is this. From the depths of that 2022 crash all the way through September 2024, the global 60-40 portfolio delivered a cumulative return of nearly 30%. It didn't just recover its losses, it generated some significant gains.
So what changed? Well, it all came back to that correlation. As inflation started to cool down, bonds started acting like bonds again. They once again became that reliable defensive hedge, providing that flight to safety that was totally missing in 2022. The stool was stable again.
But the scare of 2022 was a serious wake-up call. The 60-40 isn't dead, but it is being evolved. Investors are now adapting the classic model for a new economic era.
So here's the classic recipe we all know. 60% stocks, 40% bonds. Simple, clean, and for decades it was very, very effective.
But now, take a look at the modern approach. The stock allocation, that stays the same, but the bond portion gets split to make room for a new category, alternatives.
And this creates what a lot of people are calling a three-legged stool. You still have your stocks for growth and your bonds for income, but now you add a third leg, alternatives, specifically for diversification to provide stability when both stocks and bonds might struggle.
And alternatives isn't some vague, confusing concept. We're talking about concrete asset classes. Things like managed futures, private credit, infrastructure, and even gold. Assets that tend to have a low correlation to both stocks and bonds.
And the evolution isn't just about what you own, but also how you own it.
New technologies are making it so much easier to manage portfolios in a much more tax-efficient way, and that can lead to better after-tax returns over the long run.
So, putting this all together, what does it all mean for the next decade? Where is the resilient portfolio really headed from here?
Now, what's really interesting on this slide is the consensus from these major firms. Notice anything? For the first time in a long, long time, projected returns for bonds are right there with, and in Vanguard's case, even higher than, projected returns for U.S. stocks. That 40 in the 60-40 is finally expected to pull its weight again.
So the 60-40 portfolio isn't dead. It was tested, it bent, but it didn't break. And now it's being reinvented. The lesson of the last few years is that true resilience requires adapting to new realities, which leaves us with a final question to consider. Is your portfolio designed for the world that was, or the one that's coming?